for best results with the audio portion of this event, we encourage you to use the unique telephone dial-in information contained in the registration email you received. The National Conference of State Legislatures is pleased to partner with the Pew Charitable Trusts to bring this webinar to you. In case you're not familiar with NCSL, we're a bipartisan organization that serves the legislators and legislative staffs of the nation's 50 states, its commonwealths and territories. NCSL provides research, testimony, and opportunities for lawmakers to exchange ideas on pressing state policy issues. State retirement issues fall primarily within the jurisdiction of one NCSL standing committee, the Committee on Budgets and Revenue. NCSL standing committees allow legislators and legislative staff to exchange state experiences in shaping public policy and managing the legislative institution. They meet twice a year at the NCSL Legislative Summit and the NCSL Capitol Forum. For more information on these meetings or NCSL's activities and services to legislators and legislative staff, please visit our website at www.ncsl.org. Next slide, please. According to new research from Pew, after 9 years of economic recovery, the disparity between well-funded and struggling public retirement systems has never been greater. While some states have successfully weathered market volatility and economic downturns, others have seen their financial position decline over the last decade. Today, we'll hear from experts with the Pew Charitable Trusts as they provide a 50-state update on pension funding and analyze common characteristics of well-funded state plans. We'll also learn from the director of the Tennessee Consolidated Retirement System about his state's approach to benefit design and funding. After we hear from our presenters, we'll open up the discussion to include questions from the audience. To ask questions, you can simply type a question into the Q&A box in the right-hand corner of your screen. Your question will not be visible to everyone, only to the webinar administrators. We'll take as many questions as possible within the time allotted. Next slide, please. Our first speaker today, Greg Mennis, directs Pew's work on public sector retirement systems. The project provides cutting-edge research on pension and retiree health promises and helps states and cities undertake evidence-based pension and retiree healthcare reforms. Before joining Pew, he was Assistant Secretary for Fiscal Policy in the Massachusetts Executive Office for Administration and Finance. He also has 15 years of experience in corporate finance and strategy, having served in a variety of roles at Citigroup, JP Morgan, and a market-leading provider of retirement services technology. Next slide. Our next speaker, David Draine, serves as a principal investigator and methodologist for Pew's research on public sector retirement systems. The project's work has showcased the funding challenges that face many state and local pension systems and retiree healthcare plans, as well as possible solutions. Mr. Draine's research has looked at pension plan design, risk and uncertainty, and disclosure and transparency. Based on this work, he has advised state and local task forces considering public sector retirement system reforms. He has also conducted research and analysis on critical state policy issues involving state revenue systems, investments in transportation infrastructure, economic development, and mortgage lending. Next slide. As our final speaker, we're pleased to welcome Jamie Wayman, the director of the Tennessee Consolidated Retirement System. He was appointed to this role in January 2017 and is responsible for the administration of the retirement system, including TCRS legislation, policy, and day-to-day operations. With over $50 billion in assets, the system serves over 500,000 active, retired, and inactive members. Mr. Wayman has been employed with the Tennessee Treasury Department for 20 years in various capacities, including Assistant Director of TCRS, Manager of Financial Services, where he was responsible for an annual retired payroll of $2.5 billion, and Director of Internal Audit. We look forward to hearing from each of our distinguished speakers. Next slide, please. Now I'm going to turn the program over to Greg Mennis at the Pew Charitable Trust. Welcome, Greg.
Thank you, Anna, and good afternoon to everybody. My name is Greg Mennis. I'm Director of the Public Sector Retirement Systems Project at the Pew Charitable Trusts. Pew has been tracking the fiscal health of state retirement plans since 2007, using states-owned reported data to examine the fiscal pressures from underfunded pension and retiree healthcare benefits. In addition, our research is increasingly focused on the policies and practices of the best funded state retirement systems, pension plans that have maintained healthy fiscal status and predictable costs throughout the economic cycle, and may provide something of a model for policymakers in other jurisdictions to consider. Our forthcoming issue brief, The State Pension Funding Gap, which is to be released later this month, analyzed state data for fiscal year 2017, the most recent year for which comprehensive data were available for all 50 states. In addition, we also examined how individual states have performed over the past decade, beginning with fiscal year 2007, the first year before the Great Recession. The most recent data shows that the state pension funds in the study are on a cumulative basis posted a $1.28 trillion deficit, a slight improvement from the $1.35 trillion gap reported in 2016, primarily as a result of strong investment returns that averaged about 12% for the typical state pension plan. Then, as we look at individual states and track progress over the past decade, what we see is that the disparity between well-funded public pension systems and those that are fiscally strained has never been greater. And while the causes and consequences of underfunding in states like Illinois, Kentucky, and New Jersey are important to understand, our report casts more of a spotlight on the successful policies and practices of the best funded retirement systems in states like South Dakota, Tennessee, and Wisconsin, states that have consistently made full actuarial contributions in good financial times and bad, and have followed sound risk management policies that have allowed them to weather the volatility from investment and other risks. And with that, I will turn it over to David Draine.
Thank you, Greg. Thank you, Anna. Thank you, Jamie. And thanks to all of you for joining us today. As Greg said, we've been tracking the fiscal health of state retirement systems since 2007 using states' own reported data to understand the fiscal pressures from underfunded pension plans and retiree health care plans. And while a lot of our work is focused on the overall picture, the data is clear that there's a growing disparity between the best funded state pension plans and the worst funded. And furthermore, that the difference between them is really the result of policy choices, decisions about funding policy, about assumptions and risk, and about benefit design. Our work also has shown that there's multiple ways to succeed. And in our brief, or our forthcoming brief, we highlight 3 states that have well-funded retirement plans and have been able to recover from the impact of the Great Recession. So the overall results show a $1.28 trillion funding gap in 2017 based on state-run pension plans' own reported numbers. This is a decline of about $79 billion from 2016, and a large driver of that has been strong investment performance that added $135 billion in returns above and beyond what plans were assuming they would get. But overall, states have not taken advantage of the recovery, and employer contributions in 2017 were more than $26 billion below what we had set as a minimum funding standard. When you look within the 50 states, we saw that the 8 states with pension plans that were at least 90% funded in 2017 had funding levels rebound following the Great Recession, and that the 20 states that had pension plans below 2/3 funded not only saw funding declines in the immediate aftermath, but also through the recovery. There's been a cost to all of this, even as employer contributions still fall short of minimum funding standards. They've grown faster than state revenues, crowding out nearly $180 billion in spending that could have otherwise gone to important public priorities, which then speaks to the importance of learning from states like Wisconsin, Tennessee, and South Dakota. Not only were they the best funded states as of 2017, but they were able to maintain high funding levels while keeping costs stable, and can provide examples to policymakers trying to understand how to find a fiscally sustainable path to retirement security for public employees. So if we look back at 2000, we saw that state pension plans on the whole were fully funded and had a slight surplus. But both following the Great Recession, as well, or the dot-com crash and the Great Recession, we saw that liabilities grew faster than assets, creating a growing gap that's now $1.28 trillion. What's important to notice is not just the decline in funding in the immediate aftermath of a recession, but the failure to take advantage of a recovery among many states. Of course, any look at the big picture conceals a tremendous amount of variation among the states. And as said, 8 states were 90% funded or more in 2017 and had demonstrated the ability to recover from the Great Recession, while 20 were below 2/3 funded. All of these states had the dot-com crash. All of these states had the Great Recession. The differences among them are often driven by policy choices either made decades ago or policy choices today. So it's useful to look at what changed from 2016 to 2017 because this tells us important things about the overall dynamics of these systems. As said, state-run pension systems reported a $1.35 trillion funding gap in 2016. Stronger than expected investment performance reduced that shortfall by $136 billion. But at the same time, states were lowering their assumptions. Often, in many cases, their return assumptions were made more conservative, which added $37 billion in liabilities. And contributions fell short of the amount needed to keep pension debt from growing if all assumptions held, by about $26 billion. And then other changes, including benefit cuts in some states, reduced liabilities by about $6 billion, bringing us to the $1.28 trillion we see in 2017. It's important to note that despite these small gains, these remain at historically high levels. This is looking at Fed data on state and local pension debt as a share of GDP, over decades, and we see that following the improvement in the 90s, which led to surplus, the dot-com crash and then the Great Recession, in both cases, put pension debt on state balance sheets, and then the subsequent recoveries, we saw limited gains, if any. And it's useful to break things out between, as I said, the best funded and the worst funded, because that helps us see the disparities among states and understand some of the dynamics that have taken place. The top three states, and this is Wisconsin, South Dakota, and Tennessee, three states will be highlighting today, were about 100% funded in 2007 and remain about 100% funded in 2017. That there was a slight dip following the Great Recession, but a subsequent recovery as the policies they had in place were able to weather that downturn. Meanwhile, the worst three states, Kentucky, Illinois, and New Jersey, in 2007, they were about 70% funded. Now they're about 40% funded. And a steep and steady decline, not just from 2007 to 2012, as the aftermath of the Great Recession was being priced in, but also from 2012 to 2017, when overall investment returns for state pension plans were exceeding expectations. Meanwhile, those bottom three states have seen costs skyrocket from about 10% of payroll to about 30% of payroll. Meanwhile, the top three states, which as I said have maintained strong funding levels, have also had stable costs. If we look more broadly, we see the 8 states that are above 90% funded went from about 100% funded in 2007 to about 95% funded in 2017. We saw the worst funded states, dropping over this time period, and everyone else, ended up about 10 percentage points below where they were in 2007. On one end, it's perhaps unsurprising that the best funded states were able to recover as well. At the same time, this shows that the policy choices that policymakers are making are creating greater and greater differences and more challenges for some of the worst funded states. So what can we learn from some of these best funded states? And we profile 3 states in our forthcoming brief that we've seen have effectively managed their pension obligations. We'll talk a little bit about 2 of them today, and then Jamie will share Tennessee's experience in more detail. But Wisconsin, South Dakota, and Tennessee share the distinction being the 3 states with the best funded pension plans as of 2017. All 3 states have different benefits, different assumptions, and different funding policies, but they share some common attributes that help explain some of their success. All 3 states have consistently ensured that employer contributions were actuarially sufficient to pay for the benefits offered to workers and retirees. And ultimately, that's the sole biggest difference we see between well-funded and poorly funded state pension plans. But all 3 also have explicit policies to manage risk and keep costs stable. Understanding that, as they take on risk, that there's advantages from understanding how to manage that risk. We also see that there's no one-size-fits-all solution, and instead what these states show is that there are multiple approaches available to policymakers that are a sustainable way of offering retirement benefits to workers and retirees. So when we look at Wisconsin, they were 103% funded in 2017, and the lowest point that their funding level reached following the Great Recession was 98% funded. Their state funding policy was able to consistently achieve contributions above the minimum benchmark, and were able to pay down about $1 billion worth of pension debt from 2014 to 2017. And the way that they've set up their system in Wisconsin shares gains and losses between taxpayers, employees, and retirees. For someone working today, employer and employee contributions rise and fall equally based on market conditions, both increasing what employees and taxpayers pay in the aftermath of recession, but allowing, in the case of subsequent gains creating a surplus, employee contributions to go down as well. And then once someone retires, assets are set aside using very conservative assumptions that are expected to be fully sufficient to pay for the benefit a worker is promised. And if investment returns allow for an excess on that, that provides cost of living adjustments to retirees that could then be further adjusted as needed to ensure the full funding of those benefits. And as a result, the amount set aside once someone retires is sufficient to pay for benefits regardless of economic or investment conditions and creates no further liability for the taxpayer, allowing gains and losses to be shared between workers and retirees while someone is active, and a full understanding that the amount set aside in retirement will be sufficient to pay for the benefits promised. For South Dakota, the South Dakota retirement system was 100% funded in 2017, and its lowest funding level was 92% funded after the Great Recession. South Dakota's case, they follow a fixed funding policy with statutorily fixed employer and employee contributions, and to manage uncertainty in the fact that gains and losses will change the assets of the system, they adjust benefits to account for that. And retirees are offered a COLA that varies based on both CPI and has a cap that's automatically set at the level that will keep the plan well funded. This creates a sharing of risk between taxpayers and plan participants, but one based on clear rules that both parties can understand and plan for ahead of time. Furthermore, the state stress tests this pension system, asking the question of, are these policies going to be sufficient in a low return scenario? And what they found is that they will be. As I said, Tennessee is a successful example that we looked at in our brief, but I'll leave that to Jamie to discuss in depth. Now, across all 50 states, it's useful for policymakers to understand not just where their state is, but where it's going. And we present in our brief forward-looking measures that can help policymakers understand whether the policies in place will be sustainable over the short term and the long term. We present two measures here, what we call the net amortization benchmark, a measure of contribution adequacy, and the operating cash flow ratio, a measure of how dependent states' pension plans are on their investment performance. But we've also seen states and state retirement systems using a variety of stress testing tools to look farther out and look at projections on their range of investment and economic conditions. So net amortization is simply a measure of whether the total contributions to a retirement plan would have been sufficient to pay down some amount of pension debt, some amount of their net pension liability if all assumptions that had been met. If you hit your investment targets, if your demographic assumptions were correct, if everything else went as planned, did the amount you pay equal both the cost of new benefits, the service cost and the normal cost, as well as investment on your interest on your existing pension debt, and leaving at least some left over to pay down principal. What we see for states that perennially fall short of this measure, if things go as they anticipate, they're going to see their pension debt rise year over year and grow and grow. And then next, the operating cash flow ratio, which is looking at the difference between payments going out, primarily benefit payments, and contributions coming in from employers, employees, and other funding sources, and taking that difference as a share of plan assets. Now, for a mature pension plan, as most state and local pension plans are, the whole point is to have contributions coming in when someone works, grow through investments, and then go out in benefit payments. In other words, we expect this to be negative. And overall, the ratio is about negative 3.2% for all 50 states. But this helps us understand the dependence of public pension plans on investment performance, because what that same number tells us is that if pension plans don't get at least 3.2% investment returns in a given year, assets will go down, as well as providing an early warning sign for some of the states with the worst cash flow situations. So looking at the net amortization benchmark, we find the majority of states fell short of that in 2017 with an overall shortfall of $26 billion. But some of the best funded states we see in our data have been exceeding this measure both in 2017 and in prior years. And that's an important ability to recover from a downturn and be able to gain the advantage of having assets in place to benefit from a subsequent recovery. And then operating cash flow, as said, the operating cash flow ratio across 50 states was negative 3.2% of assets. In other words, the difference between benefit payments going out and contributions coming in equaled 3.2% of plan assets. But 5 states are below negative 5%, which we view as an early warning indicator. And Colorado's a useful example of how early warning indicators can help policymakers make proactive decisions. So beyond metrics like this, Colorado had done a stress test of their pension system that found a 1 in 4 chance of effective insolvency, based on these kind of results, and that spurred a discussion within the state about how to address that, and led to a reform effort that shared costs between taxpayers, employers, and retirees. When we look broadly after 9 years of economic recovery, most state pension plans are not equipped to face the next financial downturn. Despite strong investment performance that led to the second drop in the reported funding gap since the Great Recession and improved state balance sheets, fundamentally states can invest their way out of their pension problems and need to have sustainable policies to pay down pension debt, a test that most states failed in 2017. But when we look at states like Wisconsin, South Dakota, and Tennessee, and more broadly at the well-funded states, we see demonstrated paths towards sustainable funding, towards the ability to weather financial downturns while providing a secure retirement for public workers. And so states like this, and as well as well-funded cities and other governments, can serve as examples to policymakers in other jurisdictions looking to understand effective approaches. And that forward-looking measures and understanding not just where states and cities are, but how their policies will carry them forward over time, can help understand whether policies will be sustainable, assessing the adequacy of the reform efforts we've seen across the 50 states, as well as the impact of potential changes going forward. Thank you so much for joining us, and I think now we'll get to hear from Jamie.
Thank you. This is Jamie Wayman. I'm the director of the Tennessee Consolidated Retirement System, and appreciate the opportunity to talk about pension reform in Tennessee and the process that we undertook. Next slide, please. I want to just give you an introduction to TCRS, what we are, the size of our plan, why did we consider pension reform when we did, what were our objectives of pension reform, and ultimately what was the design of the pension plan as a result of the pension reform. Next slide. TCRS at June 30, 2018 had approximately 217,500 members. As you can see, the majority of those are in the legacy plan, but I'd like to point out that after 4 years of activity, we already have approximately a little over 41,000 employees that are covered by the hybrid plan. I also want to make the point here that when we closed the legacy pension plan to new hires, it only applied to state and higher education employees and teachers. Local governments still have a choice of 4 different plan designs within TCRS, including the legacy plan, and we're not forced to close their plan. In addition, at June 30, 2018, we had 139,500 retirees that we pay monthly benefits to. The vast majority, obviously, is the legacy plan, since the hybrid plan hasn't been in existence that long. Those that are drawn a retirement benefit from the hybrid plan are a result of local government employees later becoming teachers and higher ed employees after June 30, 2014, and having some service in the hybrid plan. And that's the reason there's some small numbers for benefit payments out of the hybrid plan. Next slide, please. As of the close of business on April 26, TCRS has $51.6 billion of assets under management, and we cover all state employees and public higher education employees in Tennessee, all K through 12 public school teachers. We cover employees of local governments where that local government has elected to cover their employees through the Tennessee Consolidated Retirement System. At this point, we have over 585 local governments that participate in our plan. Next slide. As mentioned earlier in the presentation by Pew, one of the things that I think is commonality of those that are well-funded is that payment of the required contributions, or the actuarially determined contribution. And since 1975, every employer participating in the Tennessee Consolidated Retirement System has paid 100% of the annual required contribution, as it used to be known, or the actuarially determined contribution. So that's led to fully funding the plan. At June 30, 2018, based on the market value of assets, you can see our 4 separate, legally separate plans and what their funded status is. I will make the point, we'll talk about in a minute with the new pension plan design, that there's a stabilization reserve trust, kind of akin to a rainy day fund, associated with the hybrid plans. For purposes of this slide, I have excluded those assets from the funded status. But if I were to include the stabilization reserve funds, both the state hybrid and teacher hybrid plan would be funded at 125% of the liabilities of the plan. TCRS has been consistently ranked as one of the top best funded pension plans by various rating agencies. And the state of Tennessee has also attained a AAA rating by S&P Rating Service, partially based on the funding of our pension plan and how well it's run and funded. Next slide, please. So at the time that we started considering pension reform in Tennessee, our two legacy pension plans for state employees and teachers were both funded in the 90% funded category. So why did we decide to start looking at pension reform? One was that we continued to see mortality improvements. People were living longer. Obviously, as people live longer, you have to provide benefits longer, which drives up pension costs. Another reason we looked at it is because due to the low interest rate environment we've been in for some time, even with a diversified portfolio of our stocks, bonds, real estate, and alternative investments, we still felt like there was going to be some struggle achieving the actuarial earnings assumption we had set, which was at 7.5% return. Subsequent to this, in 2016, we did lower our actuarial return assumption to 7.25%. Next slide. Obviously, there's also been extreme volatility in the investment earnings market from year to year over the last 10 to 15 years, causing volatility in employer contributions. What our experience has been is that investment earnings is probably the single largest impact to the employer contribution rates. And as you can see there, we've had rates as low as 3.5%, a little over 3.5% of payroll for both the state employee and teacher groups, but they've been as high as 15 to 19% of payroll. And because of that volatility, we wanted to look at pension reform. Next slide. It's really difficult. One of the biggest difficulties and biggest concerns we hear from employers participating in our pension plan is it's difficult to budget for pensions because of the volatility in the contribution rates. It's kind of an interesting thing that, when difficult economic times are around and we're not making, the investment market's not good, that's when we ask employers to increase the amount of contributions they make into the plan. When strong economic times are around, that's when the rates decline and they're getting, they have more monies to do with, and then they're not required to contribute as much to the retirement plan because of the investment market. So when those things happen, and then you go back to those employers and say, okay, now I need to increase your rate because of the investment markets and other factors working against us, they have a couple of choices. They can either increase taxes, they can cut services that they're providing to taxpayers, or they can dedicate or find other increased revenue sources they have and dedicate those to the retirement plan. And again, those are some of the reasons why we looked at pension reform during this time. Next slide. Also, as everybody's aware, there were new GASB accounting rules that required forward disclosure on the face of the financial statements of the unfunded liability of an employer participating in a pension plan. And for many employers, at least in our plans, those were the unfunded liability from pensions was one of the single largest liability that was going to be shown on their financial statements. In addition, the pension expense that's calculated under GASB is going to differ from the required employer contributions required by the plan. Next slide. So what were our objectives when designing the new plan? One, we were going to close the current plan to new members, but we were going to any member that was covered by that plan at the date we closed was able to continue in the plan as long as they maintain membership, and we would deliver on all promised benefits. But we were going to develop a new plan for new hires. When looking at the plan, we wanted to make sure that we considered both employee and taxpayer objectives. One of the biggest being is taxpayers should be paying for the cost of employees that are providing the services that they're receiving during their lifetime. And we also wanted to establish an effective and efficient plan. Next slide, please. So the guiding principles for us when establishing a new pension plan for our employees hired after June 30, 2014 was to establish a sustainable pension plan that could be affordable for the employer and provide sufficient benefits to our members. We wanted to look at, we recognize that employees are becoming more mobile and they're not necessarily staying around for a full career. So we wanted to allow for, create a plan that would allow those mobile employees that are leaving government and leaving the pension plan to have some funds to take with them, while at the same time providing career employees with the ability to maintain their standard of living after retirement. We also recognize, as I mentioned before, that one of the hardest things is for employers to budget for the pension cost if it's volatile. So we wanted to establish a pension plan that dictates or tells the employer up front, this is the amount of money or the contributions that you're going to have to pay to the retirement system to fund benefits. We also wanted the ability to be able to control unfunded liabilities or unfunded liabilities of the plan. Next slide, please. So what plan design do we come up with? We refer to it as a hybrid plan, and we refer to it as that because it is a combination of a defined benefit plan and a defined contribution plan. As a guide is that once a benefit is accrued, it is earned and cannot be taken away. Under this new plan design, we can increase or decrease future benefits in the event that the market conditions and the funding of the plan is in jeopardy. But we did cap employer contribution rates at 9%. That's how much the employer is going to always be required to pay to the plan to provide these benefits is 9% employer contributions. A target of 4% is sent to the DB plan, and then 5% is sent to the DC plan. Next slide, please. So under this plan design, employees contribute 5% of their pay to the defined benefit plan, and they're auto-enrolled at 2% to the defined contribution plan. Employees can adjust the 2% that they send to the DC plan all the way down to 0 where they're not contributing anything, or up to the maximum allowable under the tax laws. Obviously, the 5% that the employer is paying to the DC plan goes to the employee regardless of whether the employee is contributing to the DC plan. As I mentioned, the DB plan is funded with 9% contributions, 5% from employees and 4% from the employer. The DC plan is funded with 7% contributions, 2 from employees and 5 from employers. So again, 7% from the employees, 9% from the employer to fund the plan. Next slide, please. Under the DC plan, employees are immediately vested in all their employee contributions and the employer contributions to the plan. Employees have the ability to direct their own investment choices and make their own investment choices from a diversified list of investment choices, including the ability to participate in the state pension plan. So in July of 2015, we made the pension plan like a mutual fund and allow people to convert it to a net asset value every day. So one of the investment choices available to members of the plan under the DC plan is to choose the state pension plan as an investment option. We also provide employee education to our members. Next slide, please. Under the DB plan design, we created a stabilization reserve. So as I mentioned before, 4% is required from the employer to fund the pension plan or to fund the defined benefit portion of the plan. At the same time, every year we do an actuarial valuation where the actuary determines what the actuarially determined contribution rate is to fund the benefits under the DB plan. The difference between the 4% required contribution and what's calculated by the actuary is the actuarially determined contribution. Say, for instance, the ADC is 2%. The difference between 4 and 2 is 2, and that amount is deposited into the stabilization reserve to be used in the event in future years when there's more demands on contributions, and those contributions are by the actuary is calculated to be greater than 4%. The defined benefit plan design provides death, disability, and retirement benefits. The benefit formula or the accrual factor is 1% of salary. We also increased the eligibility to be able to retire. So under the closed legacy plan, you could retire after 30 years of service, regardless of age, or at age 60, as long as you had 5 years of service. Under the new plan, you have to be age 65 invested, or a combination of your age and service must total up to 90 to be eligible for an unreduced retirement benefit. Under the new plan design, retirees do receive a COLA based on the change in CPI, but it's capped at 3%. And again, the members always vested in their employee contributions. Next slide. We also instituted pension controls to help control the volatility of unfunded liabilities, and in the event that the cost to the employer is going to exceed 4% for the defined benefit portion of the plan, we designed the plan so that these controls are automatic and based upon the results of an actuarial evaluation. Instead of it having to be up to the vote of a board or to the General Assembly members or the treasurer, we said, let's go ahead and make those automatic, and it's based on the results of the actuarial evaluation. So what are the cost controls? So if the actuary determines that the employer contribution to fund the DB side of the plan is greater than 4%, then we've got the following actions in this particular order that get instituted. One, we look to the stabilization reserve to fund that increase that's above 5% to take that employer contribution rate back down to 4% or less. If there's not enough funds in the stabilization reserve to do that, then we also have the ability to reduce or eliminate future COLAs, reduce it below the 3% or eliminate it altogether. Next slide, please. We can also divert some of the employer contributions to the DC plan to the DB plan. As I mentioned before, employers are required to contribute 5% to the DC plans on behalf of participants. In the event these cost controls kick in, we could divert some or all of those employer contributions to the DC plan over to the defined benefit plan. We can also increase employee contributions to the defined benefit plan by 1%. We can reduce future accrual levels below the 1%. And ultimately, if things get bad enough, we could freeze the plan benefits. Next slide, please. In the event that the next actuarial evaluation takes that employer contribution rate to the defined benefit plan down under the 4% level, we can begin reversing the controls that were in place on a going forward basis in the order that they were taken, the reverse order that they were taken. Obviously, the same controls are there if the unfunded liability exceeds certain limits. So under one of the things we put in the state law is if the unfunded liability if either the state plan or the teacher plan exceeds a certain percentage of the total outstanding debt of the state of Tennessee, then we would these unfunded liability controls would kick in, and they're the same ones that we just went through. Next slide. So the real benefits of this is that we have absolute control over the employer contributions and unfunded liability. The employer knows that I'm never going to pay more than 9% to fund the benefits under the hybrid plan. This emulates a DC plan that they know exactly what their contributions are going to be year after year. Obviously, it improves the annual budgeting process for the government because they don't have to worry about volatility in the employer contribution rate. And it also provides, we believe it provides sufficient benefits for both career employees and mobile employees. Next slide. The new plan gives employees a stable pension benefit base. Tennessee is a Social Security state, so we're covered by Social Security, so they have the DB portion of the plan, they have Social Security, and then they also have the flexibility of having a DC plan that they can increase their contributions to and invest to increase their benefits. The new plan eliminates any substantial unfunded liability because of the cost controls that are in place. It's a good recruiting tool because we have a solid, good pension plan to recruit and retain employees. And we believe it's a win-win for both employees and taxpayers. Now, with that, again, I'd like to thank you for allowing me to present this today. This is the experience that we've had in Tennessee, and thank you for allowing me to present this today.
Thank you very much, Jamie. At this time, we're happy to take questions. Again, to ask a question, please type it into the Q&A box in the right-hand corner of your screen. Our first question is, I think for the folks at Pew, have you seen any trends among plans that are at or near full funded status, moving to reduce their assumed rate of investment return to shift investment allocations to lower risk assets to mitigate future contribution volatility?
I think there's two great examples that we can think of offhand. One is South Dakota. The South Dakota retirement system is first, if you look at, I think our recent investment report, it's one of the best 10-year investment profiles of the state pension funds that we track. But, despite that, chose to lower their return assumption to 6.5%. Relatedly, one of the lowest we see across the 50 states. And then I think the other policy that we've been tracking that, they're not a fully funded plan right now, but CalPERS, the California Public Employee Retirement System, has had an interesting approach that they've used to basically use good investment returns when they arrive to fund a reduction in both their discount rate and to actually affirmatively switch some of their assets into lower risk and more stable assets. So we've seen an overall move towards lower return assumptions across 50 states. The median plan now assumes that I think about 7.15% returns compared to 7.5% returns for the median plan pretty recently. And then South Dakota is, I think, one of the bigger swings that we've seen. Connecticut, once again, another underfunded state, but moved from 8% to 6.9% for state employees. And then CalPERS, though it's been relatively small shifts, it's a forward-looking process that can repeat itself to use every time they have a good investment performance, create some space to have some relief or to lower risk.
Thank you, David. This next question also for you, and then perhaps Jamie can weigh in as well. How do you convince people from both sides of the aisle that we need to be proactive for the sake of future retirees?
So while acknowledging that the politics of it is a little outside of our scope, I think the fundamental thing that we have seen in our research is that there's multiple successful approaches. So different states and different jurisdictions are going to have different policy priorities, different views on risk, different views on kind of what's a fair benefits to provide. But ultimately, within this toolbox, because as I said, Wisconsin is very different than Tennessee, is very different than South Dakota, is very different than North Carolina, is very different than New York State, all states with well-funded pension plans. Different jurisdictions are going to pick different approaches, but ultimately there's, as long as you pick an approach that works, you can be in a sustainable path.
This is Jamie, and I think I'd agree. I think it's not one size fits all for everybody. I do think it's important to try to engage membership and decision makers together when you're doing that. And we did some of that when we went through our process. So I think that's important. But again, I do think one thing I hope that people don't take from my part of the presentation is that what we did in Tennessee works for everybody. I think every jurisdiction is going to have to do what's best for them.
Very good. I believe that's all the questions we have for now, so we can wind down. If you have any questions following this event, please feel free to contact us at the email addresses shown on the screen. This webinar is being recorded and will be archived on the NCSL website. And if you'd like to continue the conversation, please join us in Nashville, August 5th through 8th for NCSL's annual Legislative Summit, where pension experts and legal scholars will parse recent judicial actions, evaluate pension funding targets, and analyze trends in retirement benefit arrangements for public workers. Next slide, please. And lastly, please take a moment to share your feedback on this webinar by taking a short survey after it concludes. Thank you very much for your interest and participation today.